Good afternoon, everyone. We would like to extend a warm welcome to you all. Thanks for joining us this afternoon for the Stockspot June webinar. My name's Hannah Hooper and I'm one of the investment advisors here at Stockspot. And with me today is Chris Bryke, Stockspot's CEO and founder, and Sarah King, our Head of Client Care and Advice. Now today we have 5 sessions lined up. Chris will be starting off with Stockspot's investment philosophy, followed on by a market update to provide a bit of context around what's happening in markets at the moment. I'll then be covering Stockspot's performance of the model and sustainable portfolios. And finally, Sarah will be covering some important updates regarding tax time and the upcoming annual review process. And then we'll wrap up the session with some questions and answers at the end. So just a little bit of housekeeping to get started. Feel free to submit some questions throughout the session. We will get through to a Q&A section at the end of today's session. So the chat can be found on the top right-hand side of your webinar screen to submit those questions. We will endeavour to get through as many as possible, but if we can't get through to you all, we'll come back to you personally after the session. Now this webinar will be recorded, so if you do have to drop off for any reason, don't worry, we will be circulating a recording after the session. And finally, any content in today's webinar is general in nature and doesn't take into account your personal or financial circumstances. So without further ado, I'll hand it over to Chris Bryke to kick off our first session on Stockspot's investment philosophy.
Good afternoon, everyone, and thanks for joining us today during your lunch times and on this very last day of the financial year. Really pleased to see such a good turnout. Now, it's certainly an interesting time in markets, so I'm sure you're also wondering, what's going on and what's our take on markets. And today I thought I would kick off before I give a bit of a market update in actually just giving a bit of a recap on our investing philosophy and how we approach investing at Stockspot. Because I think it really does set some good context for the rest of the sessions today, and particularly to help give some context around how we're thinking about the current market environment and the volatility we're seeing at the moment. So our investment philosophy at Stockspot is a little bit different to probably a lot of traditional financial advisors and investing firms. We believe, and the evidence out there does support, that there are a few things when it comes to investing that you have very little control over. What shares are going to go up or down, whether the market's going to be up or down this week or this month, which asset's going to be doing best or worse this year. We believe a lot of the finance industry is fixated on making these sorts of predictions about what's going to happen, when a lot of the evidence and data shows that it's very difficult, or in many cases impossible to do, and particularly impossible to do consistently over time. And a lot of our research into superannuation funds, our fat cat annual super fund research, as well as the ETF research we do, comparing ETFs to a lot of the active fund managers in Australia, does support that it's not something that professionals have been able to consistently do in Australia, make accurate predictions about the future. And that's why, as a business, we try and avoid making predictions and instead focus on controlling the things that we believe you can control as an investor. And we think there's a few of those. We believe that you can control, first of all, the risk that you take when you're investing. Second, you can control the costs that you're paying while you're investing. And then third is your own behavior. So making sure that you've set up good investing habits, that you're not making some common mistakes. And we think if you can follow a good process for these 3 areas that are within your control, you're really going to set yourself up for the best chance of success when you're investing and the best chance of achieving your financial goals. So as a business, what this means is when we're helping clients set up portfolios at the start, one of the things we focus on is making sure that you're taking the right amount of risk. And I think it's something that probably got forgotten over the last couple of years as markets were racing up and there was a lot of excitement about particular sectors and asset classes that were doing very well. But we really focus on making sure that every client has a portfolio with a right amount of risk for their capacity to withstand market turmoil like we're seeing at the moment, the right capacity for the time horizon that people are investing in, and also for any cash flow needs along the way. And we think this is critical to actually helping people achieve their financial goals, because a mistake that is often seen when markets fall is that people that take too much risk end up selling at the wrong point or being worried because they've lost too much and they can't withstand that sort of volatility. There's also the flip side, which is if you don't take enough risk in your portfolio, you're also, you're probably disadvantaging yourself in reaching your financial goals. So risk is important. And another way we look at risk is for diversification. So I think, again, a lot of people over the last few years got very excited about a few sectors and industries, and they forgot about the importance of really spreading your investments across different parts of our economy, different sectors, different countries, different businesses. And by doing this, you're actually able to reduce your investing risk quite a lot. And particularly, you can eliminate that catastrophic risk of having all of your money tied up in something that falls a lot. And we've seen that over the last couple of years, industries like cryptocurrency that are down 70% plus, buy now, pay later stocks that are down 90% plus. Unfortunately, when you invest, if you do put all your eggs in one basket, there is the potential for a catastrophic loss that's very hard to recover from. And that's something we try and help clients avoid. And then when it comes to your own behavior, we try and run sessions like this, as well as do other content and videos to really help educate you guys, our clients, and others to really focus on those things that you can control and really set yourself up for success. So that's a little bit about our philosophy. And the final point I wanted to make is that actually, once you've got all of that sort of stuff set up initially, something that we think is really important is to automate as much as possible. And so as a business, what we try and do is help everyone automate the process of investing, making sure people are reinvesting dividends, that portfolios are being rebalanced occasionally when the asset weights get out of kilter with your target weights, to make sure your risk isn't going up or going down too much over time. And then rebalancing and checking your investments every day, as well as simplifying the tax and the administration of portfolios. Because we think if you can avoid having to spend too much time on this, you're less likely to be checking your portfolio every day. And actually, that's one of the least healthy things you can do, because a lot of the research shows that people that check their portfolios regularly are the sorts of people that are generally tempted to make changes, and changes generally isn't what you should be doing. When you're investing, success comes from the discipline of actually doing nothing most of the time. And we think by automating more of your investing, you're set up for more of a better chance of actually having that discipline and actually not having the temptation to make changes and make tweaks, particularly at times like this. So that's a little recap of our investing philosophy. Next, I just wanted to give a bit of an overview of what's been happening in markets, as well as some of the big drivers of different asset classes over the last year, and more specifically over the first 6 months of 2022. Now, at the start of the year, in the first few months, there was a bit of market volatility that occurred, and a lot of that was due initially by the war in Ukraine and some of the geopolitical uncertainty that came about because of that. But actually, that uncertainty dissipated pretty quickly, and markets started to focus on something quite different, which was inflation. And the impact that inflation was having on interest rate expectations. And really, I think this has been the biggest and really the key driver of all different asset classes over the last 6 months or so. So taking us back to 2020, a lot of stimulus was pumped into economies, both here locally in Australia and around the world, to reinvigorate economies when COVID struck, to keep people in jobs. That stimulus came through central banks, reducing interest rates close to zero, as well as buying government bonds, as well as through governments, providing stimulus checks, for instance, in Australia. And that, as COVID has unwound and economies have recovered, has caused a whole bunch of inflation, and has been compounded by the energy issues we're now seeing out of Europe, as well as some supply chain issues in China. And last year, and even up until late last year, there was the key view of people investing was that this inflation was going to dissipate and was going to reduce in 2022, and therefore markets didn't need to be concerned about interest rates and interest rates getting jacked up very quickly to actually help curb inflation. This year, however, inflation has stayed stubbornly high pretty much around the world. So in the US, it's running at over 8% a year. In other parts of Europe, it's close to 10%. Inflation's a little lower in Australia at the moment at just over 5%, but the Reserve Bank here expects it to actually tick up closer to 7% this year. And what that's meant is that markets are now changing their views of what interest rates will need to do to actually tackle inflation. And so the chart I'm showing here on screen actually shows the the rate of return on a 2-year government bond, so the 2-year government bond yield in Australia, and that has gone from close to zero late last year to well over 3% now. And that is causing a lot of turmoil in markets. First of all, quite clearly in bond markets, because bond markets are the markets that are most sensitive initially to interest rate changes. And that's what's caused one of the biggest bond market sell-offs in Australia and the rest of the world in the last 40 years or so. So we've seen government bonds fall by about 10% in Australia in the last year. And other more risky bonds, like emerging market bonds, fall by quite a stunning 23% since the start of the year. So interest rate changes have impacted the bond market, but they've also impacted the share market, because investors in the share market are concerned about what higher interest rates will mean for households, for consumer spending, for company margins, and as well as all of those economic impacts. Just very simply, investing in shares becomes less attractive as interest rates rise, because you can earn a risk-free rate by putting that money in the bank. And right now, the market's saying that risk-free rate is going to be well above 3% in a year's time. So they're the negatives this year, and what's caused share markets around the world to fall. The Australian share market has fallen by a little less, because actually the one area that has done well, and I'll show a few charts later to show this, has been commodities, which have been beneficiaries of inflation. And our share market does have a higher exposure to resource companies. However, a lot of share markets with a bigger tech exposure and growth exposure have really suffered this year and are down 20% plus. And that's obviously transpired across, diversified portfolios like ours. The positive, however, is that there is already a lot of negativity baked in. So like in March 2020, when the world was concerned about the impact of COVID and the lengthy impacts of that on economies, there was a lot of negativity baked in there, and a lot of people didn't didn't expect the positive response from central banks. Look, right now in Australia, there's a lot of negativity baked in, because markets are expecting interest rates to go up very high and very quickly. Even today, I saw that Commonwealth Bank has increased its fixed rate mortgages to by 1.4%, which is a huge move, and to over 7% on 5-year fixed mortgages. But the market now does anticipate this, and so if there is any easing of interest rate expectations, it could be a positive for markets. So what does this mean now for different asset classes? So as I mentioned before, the one asset class that has actually done the best this year is commodities generally. Now, we don't have a direct exposure to commodities in our portfolio, but indirectly through Australian shares, you do have a higher exposure to commodities because of our market's resource component and the big part of our market that companies like BHP and Rio Tinto make. Gold is the other asset class that's up, even though it's just slightly this year. And as of yesterday, it's up about 5% for the year. Some areas of infrastructure are also up for the year, because inflation protection is often built into infrastructure assets. However, pretty much every other asset in the world has fallen in 2022. And the worst performing assets tend to be those ones that are the most risky, and they're the big growth areas of the share market, as well as asset classes such as Bitcoin. The positive out of this is that our investment approach doesn't try and predict which asset class is going to go well or poorly, and that's why we always do spread our assets, spread our investments across a range of different asset classes. Some have been these asset classes that haven't done as well recently, like global shares. But then on the flip side, we do have exposure to assets like gold, which have done relatively well in this environment. And what we're seeing at the moment, and Hannah will extrapolate a bit more later, is we're starting to see a little bit of rebalancing again out of assets like gold that have done well to reinvest into share markets at these lower levels. So our advice at the moment is that it's more important than ever to be staying diversified in a world where the future is unknowable. And although there's a lot of people that will predict where interest rates or inflation or growth will be in a couple of years, it's quite clear from the last few years that predictions are pretty pointless, and no one really knows where markets are heading in the next little while. But what we do know is over the long run, investing is a great way to grow wealth and certainly has produced a better return than leaving your money in the bank over the long run. In order to get that great long-term return, you need to put up with some level of market ups and downs along the way. However, we think you can be sensible by reducing some of the risk through spreading money across different asset classes and assets that do well in different environments. So, gold and commodities are doing well now, but if the world starts to be concerned about deflation again, it may be government bonds that starts to do well, or it could be a different share market around the world. So we don't see any reason to make any changes to our asset classes. We actually increased our gold exposure about 18 months ago to be better protected in an environment where shares and bonds both fall together, which is exactly what's happened. Certainly, it's really difficult to go through any sort of market dip, but we're confident that a diversified approach is the right one, a low-cost approach is the right one, and that if you continue to stay invested and weather periods of market volatility like this, you're going to be in a good position to achieve your long-term financial goals. As Sarah will be talking about later, though, it is important to review your investment situation and profile, though, to make sure that you're always in a strategy that's aligned with your investment time horizon, which is critical to make sure you're not taking too much risk. And with that, I'd like to hand over, or actually one last slide I'll share, which is actually looking at the context of this market fall this year compared to other years. Now, we're only halfway through the year, and so 2022 isn't updated on the table in the left here, but I thought this was an interesting table to share, which shows the worst years in history for a balanced portfolio. So this looks at a portfolio that has 60% shares and 40% government bonds, commonly known as the 60-40 portfolio. And this year, this 60-40 portfolio is currently down about 7.5%. That would make it the 7th worst year over the last 100 years. And you can see it's in some scary company there with the Great Depression, some inflation crises in the 70s, the financial crisis, World War II. But actually what's important to note is if you zoom out and look at longer timeframes, and the table on the right-hand side shows this, over every 10-year window in history, a 60-40 portfolio, at least up until now, has generated a positive return, which shows the value of staying invested and not worrying about these years where there are temporary dips in the market. And so I'd like to hand over to Hannah, who's going to share a little bit more on the particular performance of our portfolios, the assets within our portfolios, and what it's meant for those performances, as well as zooming out to the longer term. And then Sarah's going to take over and talk about our annual review process and tax this year. So thanks again for joining, and I'll hand over to Hannah now.
Thanks, Chris. So the focus of this next session will be on the performance of Stockspot's portfolios, and that's across the model portfolios, which we launched in early 2014, and the Stockspot sustainable portfolios, which were launched in July 2020. So if we first start off with the Stockspot model portfolios, so over the last 12 months, the portfolios have performed from a range of, the most conservative portfolio is negative 3.7%, and that's as of the 31st of May 2021, and that ranges up to 0.6% for our high growth portfolio, which is Topaz. And as you can see, the high growth portfolios have done a little bit better than the more conservative portfolios over 12 months. And this is really due to the underlying asset performance within the portfolios. And what we've seen is over the last 12 months is that the share markets have fallen. And as Chris has mentioned, the bond markets have also taken a bit of a hit over the last 6 months or so. And that has had an impact on the portfolios. In fact, most of the assets within the portfolios are down around 10 to 15% year to date. However, one of the best performing asset classes, and what's great to see is in all of the Stockspot portfolios, is gold. And that's actually up around 5% year to date. So given these current market conditions, what does this mean for the portfolios? Well, it's likely going to be our first year of negative returns here at Stockspot since we launched our portfolios. But I think it's important to mention that it's actually very normal to experience a 12-month period of negative returns in a market cycle. It actually occurs generally on average about every 6 or 7 years. It's a natural part of investing, and we know that whilst markets can be volatile in the short term and over periods of a year or two, over the long term, markets have always risen. And as you can even see from the portfolio returns over 3 years and 5 years, it helps to demonstrate that these are all positive returns, and it really reiterates that time in the market is going to give you the best chance of success. And that's actually why we always recommend being invested for at least a few years when you're investing in one of our portfolios. And I'll move on to the sustainable portfolios now. So if we take a look at the performance here, we can see that the conservative sustainable amethyst portfolio is down around 3.4% over the last 12 months. And that ranges up to sustainable topaz, and that's down about 0.1% over the last 12 months. So the sustainable portfolios have performed broadly in line with the model portfolios, and that demonstrates as well a similar level of risk within the model and the sustainable portfolios. Now, there are some slight differences, of course, because in the sustainable portfolios, there's actually a very strict screening criteria which accounts for, ESG, so environmental, social and governance factors, and therefore it will have slightly different exposures. But overall, both portfolio strategies have performed fairly in line with each other. And on the topic of performance, one of the common questions that we get from our clients from time to time is, should I be switching my strategy in order to help me get a better return in these periods? And often we see people who are wanting to maybe invest into a higher growth strategy because the performance might be marginally better during volatile times. Now, our advice to clients is to not actually switch strategies based on market conditions, because what that can lead to is actually locking in losses, and it means that you could be in a portfolio that's not actually suitable for your risk profile. So one of the key tenets of passive investing is actually not to change your strategy or to do anything different purely based on market conditions. However, if you did have a change in your personal or financial circumstances, like your investment time frame might have changed, or your appetite for risk might have changed, that's when we can look at, maybe switching into a different strategy. And Sarah will be talking about our annual review process later on in the webinar, and what may be considered, a change in your circumstances and how we go through that in our annual review process. So now I'll move on to having a look at the benefits of time in the market and diversification. So what you can see here is a chart highlighting the returns of our model portfolio since we launched back in 2013. And you can see the benefits here of staying invested over the long term and markets rising over long periods of time. In fact, share markets are actually rising over 75% of the time. But as part of being invested, one of the, the rewards of getting a higher return over the long term is being susceptible to some of this temporary market risk. And you can see that whenever markets have fallen, this has been followed by periods of strong gains. And you can actually see that from the 2015 to 2016 market sell-off. And very quickly after that, by about mid-2016, markets had reached new market highs. And then if we move on, we can see that there's a strong rally in markets up until about March 2020, when the COVID-19 pandemic, spread around the world and share markets crashed by up to 35%. And again, what you can see is a very steep drop there, but it's followed by a strong period of growth. And that was up until about mid last year. So you can see that it's very normal to see these types of periods where markets are tracking sideways or falling. And when you zoom out, it's only then that you can really see that the long-term trend is upwards. And whilst it can be tempting to change strategies or even panic sell in these periods because it is unnerving, you can see that there is a bit of a risk if you withdraw your money when you don't need it, that you'd be locking in losses, but also potentially missing out on these strong market gains, which often follow market falls. So it definitely pays to remind yourself of the big picture. And when we're going through market corrections like the one we're seeing now, the best thing to do is stick to your strategy, remain diversified, and perhaps if you have the means to top up your portfolio where you can. Now, the importance of defensive assets, this is something that Stockspot has in all of our portfolios, defensive assets, and that's in the form of government bonds and gold. And in any diversified portfolio, it is really important to have asset classes that don't all move in the same direction. And so what we can see here is that, in two big market crashes historically, we've got the global financial crisis on the left, and on the right, the COVID-19 market crash. You've got gold and bonds as the two asset classes that have actually provided a cushion in the markets. They're the only two actually out of what can be considered defensive asset classes, like some of the other negative bars during these periods, like property, hybrids, infrastructure. Even in these market crashes, it was really only government bonds and gold which provided investors with that protection. And that's exactly why we have them both in our portfolios. Now, that said, it doesn't mean that both gold and bonds are always going to be going up when markets fall. And we're currently going through a period where bonds are actually down at the moment, just given where we are in the market cycle. But that's okay, because you've got gold in the portfolios, which has been able to help protect all of our portfolios and has been up year to date. So I think it's an important one to call out there. What it also means is, and some clients on the line, you might have seen that Stockspot perhaps has rebalanced for you over the last few months. And rebalancing is where Stockspot is your advisor. We're constantly looking at your portfolio day to day. And if you're very overweight in certain areas, probably gold in these types of environments. So gold's gone up in value, so you're overweight. You might equally be underweight in shares because the share markets have fallen. And rebalancing is a really important part of risk management and something that Stockspot takes care of for you. So we'd be selling a little bit of gold to bring you back in line with your target weighting of about 15% and buying into shares. So buying in when the market's low. So when the share market recovers, it helps you lock in some extra return, and importantly, helps to minimize the risk in the overall portfolio. Now, I will hand it over to Sarah King, and Sarah will be running through tax time, which is just around the corner, and the annual review process as well, which will be commencing over the next couple of weeks. So Sarah, I'll hand it over to you. Thanks, everyone.
Thank you so much, Hannah, and good afternoon, everyone. Thanks again for tuning in for our webinar this afternoon. I'd also like to acknowledge we've seen a few questions coming through in the Q&A, so we'll definitely get to those after this session. So yes, it's hard to believe that the financial year is upon us. So I just thought I'd talk a little bit about today about what's ahead for tax time, as well as our upcoming annual review process that you've heard Chris and Hannah mention a couple of times throughout the presentation today. So kicking on with tax time, I'm sure lodging your tax return is becoming much higher on your agenda as we enter the new financial year. So very broadly speaking, any income that you earn from your Stockspot portfolio over the last financial year, so FY21-22, must be included in your upcoming tax return. Now, our job is to make tax time as easy as possible for you for your Stockspot portfolios, if you have multiple accounts for all of them. And what we'll do is issue you with a single annual investor statement. And what this does is it summarises all of the income that you've earned from things like distributions in your portfolio, as well as any capital gains, capital losses, any franking credit entitlements, any offsets you're entitled to or allowable deductions into a single statement. And that's for all of the ETFs in your portfolio. So that will save you a lot of time and make tax time quite easy for you. Now, the most common question we get from the start of the new financial year is, when will my investor statement be ready? As you can see there, it will be mid to late August 2022. And the reason that is because the actual ETF issuers, they take quite a bit of time to do their own tax and prepare all of those individual tax components for your portfolio, which they then send to us. So that really extends that timeline out towards the latter part of August 2022. But don't worry, we'll definitely keep you updated. And what you might see towards the end of July and early August is some of the ETFs flowing into the MyGov tax portal. Now, what we recommend is that you wait until we issue you with your fully comprehensive investor statement so that you can easily complete your tax return. We will issue you with a very handy tax guide that answers all of those common questions around how to complete your tax. Now, it's good to point out the only account type that doesn't get this annual investor statement is company accounts, and that's purely because of their different tax treatment. But what all of our clients will get, including our company account clients, is a comprehensive tax reporting suite. So that includes the guide I already referenced, as well as other documents like a realised capital gains report, investment transactions report, and a cash transaction report. And what you'll see is these will be all uploaded to your dashboard view, so not the mobile app, in the dashboard, in the documents section. And now, if you do actually have an accountant who does your tax return, you can make it quite easy for them by inviting them to get a view-only access to your dashboard, and you manage that in the Your Profile section of your dashboard. And I'm going to take you through that in a moment. It's a new, newly refreshed setting that we have, but basically they'll be able to log into your account, download those tax documents, and it saves you both a lot of back and forth and a lot of time. So don't worry, we will be sending an email, in fact, today on the tax timeline with more detailed FAQs and a link out to an article that you can read in your own time, which answers a lot of the more technical questions around the tax side of things. Okay, and then finally, moving on to the annual review. So this is coming up on Friday, the 8th of July. So anyone who's quite new and hasn't done a review with us previously, because we're an investment advisor, we want to check in to see if there have been any changes in your personal circumstances or your financial goals that may mean that a different portfolio is right for you. What we want to check is that the one that you're in currently is the right match, or do we consider that, yeah, you switch? So your investment profile is something we ask you to update, and it's really made up of 6 key areas, which you can see there. It's really your investment goal, your risk profile, which is quite important, your investing time horizon, which Chris mentioned quite early is really essential when you're investing, that you have time on your side, your investing experience, your need for income along the way, and also whether or not you have any high interest debt. So a very small change in any of these things could mean that an alternative portfolio or strategy, we call it, is right for you. Now let's go through what the annual review process actually looks like. So it will be running from Friday the 8th of July, so not tomorrow, but next Friday. We will email you and let you know that the annual review process has commenced. What we'll do, and you're actually getting a bit of a sneak peek into our refreshed dashboard navigation here, you'll see that we have a new simplified Your Profile section. And this is where we'll ask you to navigate to complete your annual review. Where there's the magnifying glass there, you'll see that there's a big blue button that says complete my annual review. So you'll click on that, and then basically we're going to step you through most of the questions we asked you when you originally joined Stockspot. We're going to ask you questions around your goals, questions around your time frame, questions around your risk appetite mostly, and then we're going to look at what portfolio you're in now, and we're going to compare the responses to the questions that you just gave and look at what portfolio you've been matched to this time around. Most of the time, sticking with your current portfolio is right, but for clients where your time frame has changed or your risk appetite has changed, it may mean that we recommend that you change your portfolio. So we'll come back to you with your annual review results straight away. That's something new we're doing this year. So when you complete that annual review, please check your inbox for your annual review results. And there will be a couple of options there that you can consider for your portfolio and your circumstances. But always, if you have questions, know that our client care team, myself, Hannah, the team, we're here to speak with you and answer any of those questions and help guide you through that annual review process. It's really quick and easy. It won't take you too long. And for clients, if you do have multiple accounts, make sure that you are doing your review for each account. And you'll do that by clicking the arrow next to your account name in your dashboard. You'll see your other account appear and you switch to that dashboard, go to the Your Profile section and complete that annual review. Now, that's pretty much a wrap for what's ahead for tax time and the annual review process. Don't worry, if you're worried you'll forget that all of the steps involved, we'll be sending you plenty of comms around this. So just make sure that you're regularly checking your emails over the next few weeks. Okay then, so now we are going to launch into the Q&A session. I will loop Hannah and Chris back in and we can go ahead and answer a lot of those questions.
Thanks so much, Sarah. And thank you everyone as well for posting your questions throughout the webinar. So we've got a few here which I think we'll kick off with. So we've got a question around adding long-term treasury bonds into a portfolio. Is that possible? So perhaps I can speak to that. In terms of the Stockspot portfolios, we do have exposure to IAF in all of the portfolios, and that's giving you exposure to a range of different Australian bonds and fixed income securities, and that's across a range of different maturities and durations. So it includes short-term, medium-term and long-term bonds. So there is some exposure to 20-year plus bonds, but on average it's around probably 5 to 10 year in duration. In terms of long-term treasury bonds, so usually that's referred to as US Treasury bonds. We don't have any direct exposure in the Stockspot portfolios to these to US Treasury bonds, particularly with any long-term bond. They're quite sensitive to interest rates, and that's why we would want you to have really good diversification across a range of different maturities when it comes to bonds. We do, however, have Stockspot themes, and there is a global bonds ETF theme which you could look to add to the portfolio as another option. So that'll give you some global bond exposure. So hopefully that addresses that question. And Chris, perhaps I'll pass the next question across to you. This is around Stockspot, and will we be looking to increase the percentage of gold in the portfolios?
So yeah, great question. I think that was from Angus. So Angus, historically, we've actually increased the allocation to gold twice before. So in 2017, we increased it from 10% to, I think it was 12.3%. And then in 2011, we increased it further to 14.8%. Now, if you look at other investment funds or investment advisors out there, a gold allocation of 15% or so is quite unique. I haven't seen too many out there recommending that higher allocation to gold. We truly believe it's justified, and it's sort of starting to show now in a year where gold was up 5% and government bonds were down 10%. There was essentially a 15% difference just in the last year. So it has helped to provide some protection. The challenge with adding more is that over the long run, you do want a higher allocation to growth investments in your portfolio. Gold does provide a lot of value in periods of market turmoil, when markets fall, when there's volatility, when there's fears around inflation. But if you have too big an allocation to gold in your portfolio, it can actually become a bit of a drag over the long run. So it's about finding a balance. We certainly don't increase allocations to asset classes just because they've done well in the past, because typically what you find is an asset that does one year well may not do well the next year. The reason why we actually increased the allocation to gold was because we saw the data showing that shares and bonds were starting to move in the same direction. And actually that was making the portfolios more risky unless you actually address that risk by adding an asset class which didn't have the same sort of experience as moving in the same direction as shares. So we think a 15% allocation or so is the right allocation for the portfolios. It will improve the quality of your returns over the long run, which means it will give portfolios a smoother ride. And although when any asset class rises, it's always tempting to add more to it at that point, we don't think that's a good reason to add more to gold. And so we think we're currently at the right amount.
Great, thanks, Chris. And Sarah, I might pass the next question across to you. And this is around self-managed super funds, and does Stockspot manage SMSF portfolios?
Yes, thanks. I think that one's come through from Vanessa. So Vanessa, you can invest through an SMSF into a Stockspot portfolio. Absolutely. We have a range of account types from individual, joint, for trust accounts, kids, as well as self-managed super funds. So what we can manage for you is that investment component. So you can access all of our normal portfolios, our sustainable or the model portfolios. And I expect that you've already got an active account with us. So you could actually go, assuming you have an established SMSF already, you could log into your dashboard and choose to open another account in the name of your SMSF. But what we don't manage for our clients is that administration and audit component. So you'd first want to, if you don't have an established SMSF already, you'd want to go and do that with an external provider. You need to get a trust fund deed for your SMSF, set the investment strategy, all of those responsibilities that come with managing an SMSF. And then you'd also engage most likely that external provider to do the ongoing audit and compliance for your SMSF. And we can make it really easy for you. We can, you can export transactions out of your dashboard to import across to your SMSF administrator. So yeah, certainly it's possible. And we have lots and lots of SMSF clients that we're helping at the moment.
Thanks, Sarah. And I think we've got one final question here from Mark around how long it typically takes for markets to recover. So, Chris, I might throw that one over to you. And yeah,
it's probably a question a lot of people are wondering at the moment. So markets are obviously down this year, and you know when you're when you're down and markets are in the red, you know it's probably natural to wonder, when am I going to be back in the black? The answer is unfortunately not the one that you want to hear, which is it's very hard to know. There have certainly been times in the past, and 2020 was a great example where markets have recovered extremely quickly. You know, because of some of the reasons I mentioned earlier, central banks really responded with a lot of force to support you know, households and markets generally. But there are other times in history where markets have taken a lot longer to recover. So if you look at history, I think over the last 100 years, if my memory serves me right, there's been about 39 or so corrections of more than 10%. And we're in one of those corrections at the moment. They typically happen once every 2 years, a correction of more than 10%. And on average, those corrections have gone down to a fall of about 13.9% at their worst. You know, we're probably going to go past that in this correction, and certainly in the US, we've already gone past that. And so the depth of the falls always varies, and then the length of the recovery, you know, also varies. Unfortunately, you know, it's very difficult to time, you know, when the bottom is going to be and how long it's going to take for markets to recover. However, if you zoom out, what we do know over the long run, and Hannah showed this nicely with a chart earlier, is that the best way to benefit from the long-term uptrend is just to stay invested during times that are tough. It's very tempting and psychologically very tempting when markets are falling or going sideways to pull your money out of markets and think, okay, I'm going to wait for markets to recover. You know, unfortunately, you often miss those recoveries because they happen very quickly. Markets can move up by, you know, 5 or 10% in a matter of a week or two. And if you're out of the market, that could be a whole year's worth of returns that you're missing out on. So if you do want to enjoy the long-term returns of the market, you know, our advice is that you just need to stay invested, but make sure you're not taking too much risk so you can withstand these sorts of falls. You know, this is why with a mix of assets, the falls are less severe. And I can imagine a lot of people at the moment that are invested very heavily into a sector like technology or cryptocurrency are really struggling to hold those positions, and rightly so, because, you know, a sector can have a huge drawdown of 70 or 80 or 90% historically. And if you have all of your wealth tied up in that way, it's going to be very difficult. So yeah, unfortunately, it's not a clear answer, and probably not as clear as you want, but our view as a business is that the future is very hard to predict in the short term. And while you'll see people, you know, probably in the media predicting markets are going to fall further or that there's going to be a recession, there'll also be people that expect there's going to be a recovery. You know, my experience in markets tells me when everyone is most negative, that's probably when you want to be positive, because that's when all the bad news is already baked into the market. And actually the advice I would suggest is when markets are down or going sideways, it's just a great opportunity to continue to dollar cost average, because you're buying at a lower price, you're buying more units than you could have if markets were higher. And over the long run, that will actually help you earn a better return.
Great, thanks, Chris. And it looks like we also have a question from Ursula regarding what actions Stockspot would take if the markets fell by 70%. So I can talk to that. So Ursula, what we do here at Stockspot, and I touched on it in the presentation, is around rebalancing clients' portfolios. So in every Stockspot portfolio, you'll have a target weighting. Depending on the strategy you're in, each of your investments will have a set weighting. And as the markets drift, and they might be drifting slowly over time if not much is happening, or it could be due to a big event like a market downturn, or, you know, like what we're seeing at the moment, share markets down, you know, in different asset classes, we will actually be monitoring the different weightings in the portfolio. And rebalancing is a bit like there'll be a trigger when you're too overweight or underweight. So that's really one of the most important things to be doing for your portfolios is rebalancing and making sure that even if the share markets fall, you're topping up your exposure to make sure you've got the right allocation to shares as well as bonds and gold. So it's all about that asset allocation and protecting and ensuring there's the right amount of risk in the portfolio. So regardless of market conditions, the most important thing to look at is really the investment time frame, and just making sure that and you can reach out to our team as well in the, you know, if there is a big, you know, crash 70%, feel free to give our advisors a call. But day to day, we will be managing the portfolios, rebalancing, and also assessing the asset allocations as well.
One final question then, and to add to Hannah's answer there, a market fall of 70% across broad share markets isn't something, you know, that has a historical precedent, so it wouldn't be something that you would expect to see. However, you know, it is also a scenario in the past where markets have fallen or gone sideways for a long period of time. And the mid-1970s to early 1980s was a good example where there was a period of 5 or so years where share markets and bond markets did nothing. Interestingly, over that period, gold was up about 1,700%. And so again, it shows the importance of diversification across different asset classes, because there will be sometimes extended periods where one or two asset classes do poorly. There will be an asset class in that time horizon that does well, though, and so you want to have a broad mix. Now, one final question for those that want to stay on the webinar for a few more minutes. I saw from Alexander, which is a good one, and actually one I've written a blog on and done a video on in the past, which I'll share with you after as well, Alexander, which is, if I'm looking at a 20-year time horizon, should I still care about defensive assets? And I think a lot of people who are looking at really long time horizons, you know, ask this, you know, why would I have any defensive assets given their returns are typically lower than growth assets if I really have a very long-term horizon? You know, there's a few reasons why we believe even if you've got a long-term horizon, you should still have some defensive assets. One of the reasons is just psychologically being able to withstand those big market down events. With some defensive assets, it really improves the quality of returns, which means how bumpy that ride is. And although you may think that you can withstand a 50% down in markets, unfortunately, that may not be the case. That might correspond with a time in your life where you actually need the cash flow for yourself or your family. And so having defensive assets helps to protect some of that downside. You know, 2020 was a good example where a lot of people weren't expecting to lose jobs or need money. The last thing you want to do is sell a portfolio which is down 35%, which is what happened to the share market, and actually defensive assets help to reduce that downside. The second reason is one that is that although defensive assets over 100 years have done worse than growth assets, there are periods of 10 and 20 years where defensive assets have actually done better than growth assets in some markets. And a good example of that is actually in Japan. Since the end of their late 80s, early 90s bubble, government bonds in Japan did much better than shares for an extended period of time. And so defensive assets, while history would suggest they often earn a lower return, there are periods where they actually earn a higher return as well. So for that reason, we would stick to keeping some defensive assets, even if you've got an extremely long-term time horizon. And it's actually even something Warren Buffett advocates. So he said with his will, after he passes on one day, he wants to put 90% in shares and 10% in government bonds. And this is for a perpetuity that he wants to last forever. So even Warren Buffett believes there's some value in defensive assets.
Thanks, Chris. Well, I think that about concludes the webinar for today. So thank you everyone for joining over your lunchtime. We'd love to hear any feedback that you have, and we will be circulating a survey after today's session. If we didn't get to any questions, don't worry, we will come back to you personally after the session. And if you have any questions and you want to reach out to our team directly, feel free to call or email across any questions to our client care and advice team. Now have a lovely day, everyone. Thanks again for joining. Chat to you soon.
Thank you.